In market news now, global shares are up and Asian equities climbed more than 1%, with the biggest gains in Hong Kong. Some newspapers in China have published reports flagging the likely adoption of more property support policies, along with steps to boost business confidence. Meanwhile, markets are awaiting U.S. inflation data that's due tomorrow to see if price pressures are continuing to moderate, which could provide clues on the interest rate outlook. Investors hope this week's U.S. inflation data will support an imminent end to rate hikes. To give us more perspective, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. When you look at market sentiment right now, what's driving markets both locally and abroad?
You know, for the fact that we've been waiting so long when it comes to the stimulus from China, and seemingly since Monday we are seeing signs that at least they're starting to do something, and they started with their retail in the property market, and we hope there will be more going forward because the economic recovery has been uneven. And also when it comes to the CPI that the US one tomorrow, markets are expecting that it will show that at least it don't be going up that much, and that might give a hint that as much as we expect the US Fed to raise rates in the July meeting, going forward, they should be at least looking at the pausing. And in this instance, market thinks that by the end of this year, probably the guys will have peaked when it comes to the issue of increasing interest rates. And remember, so far, markets have been worried about the fact that interest rates have been going up, and that weighed negatively on the market so far this year.
So when you look at some of the macro factors playing out both locally and I suppose let's even bring in the US markets, is this a market that's beholden to those macro factors? How are you interpreting it?
So far, that has been the issue. I mean, company fundamentals have been thrown out of the window, technicals as well. Markets have been driven more by headlines. And as we have known, that the issue has been interest rates, the issue has been inflation, the issue has been the tensions between or the conflict between Russia and Ukraine. Those are the things that have been driving the markets. And at some point, we had some geopolitical tension that was expected when it comes to the likes of China and the US because of Taiwan. Now we see some issues when it comes to trade because of the semiconductor issue. The US imposed export controls, then China retaliated doing the same. So markets have been driven mainly by those kind of events.
So on that note then, when you look at your portfolio, perhaps even when you look at your screen, what do you see as the risks to equities, and how do you factor those risks as you look at your year-end calls?
I think so far, I don't think the markets are too complacent, because I don't think the risk reward that we're seeing in equity so far is justifiable, given that there's a possibility that we might get a soft landing, if not a mild recession. There's a possibility that we might see consumer spending softening. There's a possibility that we might see the escalation of the tension. So I think cash goes with us. And also, if you look into government bonds, the likes of corporate bonds and equities, we tend to be more underweight.
I want to bring it back to South Africa for a bit. I mean, we touched a little bit on what you're expecting for the Fed meeting in July. What's your base case then for the Reserve Bank in their July meeting? You're expecting a hike?
Most probably, because they're going to need to continue to close that interest rate differential between the US dollar and also the rand. And also, if you think that the likes of the European Central Bank will continue to increase, but we also expect them to pause sometime before the end of this year. And yes, we acknowledge that our inflation is still at elevated levels, but they need to give it some time when it comes to the interest rate hikes that they've been doing to start working into the economy. So I think probably this might be the last hike that we might be getting from the local Reserve Bank.
On Friday, we kick off U.S. earnings seasons with the banks kicking us off. What are you going to be watching out for, or rather what's important to pay attention to as a lot of these U.S. companies publish their results?
You know, we know that companies and many economies have been relying on the reopening of China, and so far that has been disappointing. So we just want to see the impact of that when it comes to the earnings. And already we've seen some consensus that people expect earnings to be almost 6.5% lower compared to the prior period.
Are your clients asking you about how they can get into this AI frenzy, just in case they may have missed the boat in the first half of the year? And what's your response?
Definitely they are, and we are telling them that there are smaller and bigger players who are trying to close the gap, when it comes to the big guys who have already made good strides, meaning there's still a lot of opportunities. You don't have to chase those that have already started making good money and the share prices have skyrocketed so far. So you can still catch up on the small to medium companies that are gradually closing the gap.
Locally, what are you liking at the moment? Are there specific sectors or perhaps even a geographic split if there aren't particular sectors in South Africa?
I think we are more comfortable with the government bonds, given the yield that they offer. We're more comfortable with cash. And yes, we do have some stocks that we think they stand a good chance. People might think that yes, it's out when it comes to telecom, but we think there's still some potential when it comes to the likes of telecom going forward. Whether they get to be bought out or not, but if you look into their whole infrastructure, just look into their network, the fiber network, they've got almost 165,000 kilometers, and you combine these other ones from all these other players, it's just under 140,000. So the guys, they've got scale. And the question here is for them to get the cash injection to be able to make sure that they benefit from their current assets.
Well, I certainly do hope we get to unpack Telkom, especially in the next couple of months, as we see how the consortium that has been put together by former Telkom CEO Sipho Maseko comes to the table, and whether they actually do pursue that aggressive or perhaps even that takeover bid, or they come back to the table with the Eskom board. We'll see what happens, but I do look forward to unpacking more of the fundamentals behind Telkom's strategy with you, Makwe. But let's leave it there. Thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers. Let's take a quick break. When we come back, we'll have more news for you. Stay tuned.